I got an email from a guy after I made a video talking about how I was 80% in equities and 20% in fixed assets. And I was talking about my returns, and this individual challenged me on how much risk I was taking, um, you know, to get those returns. And he said, "Can you give me your returns that you get per unit of risk?" Probably some complicated math answer to that, but I'm going to attempt to answer that with today's video. So when most people talk about risk in the stock market, you got the S&P 500 ETF, they're going to immediately go to something called standard deviation. Standard deviation is a calculation, okay? So if you have a data set of 100 variables or 100 points, and you can calculate a mean, an average, and you can also calculate a standard deviation. How much do those data points deviate from the mean, standard deviation? Okay, as an example, like you may have the S&P 500 may have a standard deviation somewhere around 15. These are for illustration and simple math by me. So bonds may have a standard deviation of 5. So you can see that stocks have 3 times the variability than bonds, okay? So, higher risk, okay? Higher risk. Also, a lot of people use 3 standard deviations because that will explain 99.7% of the probability, assuming it's a normal distribution. You see that bell curve. I don't know if you statisticians are out there. If it is a bell curve or normal distribution, 3 standard deviations should explain 99.7% of the data set, okay? So for stocks, long-term average is right around 10%. Plus 3 standard deviations means any given year you may get 55% return. And minus 3 standard deviation says you could be as low as minus 35 in any given year. So when people are talking about risk, 9 times out of 10, when I'm reading an article, listening to a YouTube video, they're talking about standard deviation and this. Yes, I agree with this, but I'm going to talk about how time changes this. In the show notes, I'm going to show a document or a link to a document that shows where I got this data from, so you can look at charts and read the article, okay? But I'm going to give you a summary here. So if we look at 1-year returns, and these are all S&P 500, 1-year returns, the best one returned 61%, 61%. So just looking at one individual year, I can't remember how far back in time this went. It was at least 1929 because I saw a data point from that. So 61% was the best 1-year return. The worst 1-year return was minus 43%. And these are month-by-month returns. So this is not necessarily calendar years. It could go from June to June of a particular year was the worst. So not necessarily calendar years. So don't blow up the comments by saying there's never been a year that bad. There's been a 12-month period that bad, a rolling 12-month period, okay? So you can see a lot of variability here. You invest in the S&P 500, you'll get somewhere between 61 and a minus 43. Yeah, that sounds like a lot of risk. Okay, but if you start looking at 5-year periods of time, again, month by month, 5-year periods of time, the best 5-year period was 30%, and the worst was minus 7%. So look at how the variability of this, which is about 100 points, goes down to 37. Okay, see how that change in the spread of the data. Okay, so in 5-year periods of time invested in the S&P 500, your risk goes down. That's my whole point. The risk goes down. Let's take a look at 10-year rolling periods of time. The best of that it's returned in 10-year increments, not calendar year, but 10 years, could be February of 39 to February of 49, okay? 19%, and the worst was minus 3%. By the way, I did find that, hey, 93% of the time during these 10-year rolling periods, it was a positive number. So it was a positive over here. So pretty good odds if you invest for 10-year periods of time, you're going to be between these with an average somewhere of around 10. So that actually feels pretty good. So, and answering this question from a viewer, risk per unit of return, or return per unit of risk, sorry, it really depends on your time frame. The longer period that you keep it, the lower your risk becomes. And this is why when I invest, when I look at the stock market, money that I need in less than 7 years, I don't have in the stock market. I really like 10, and that's why I'm 80-20 right now. I wanted to have 10 years out of the market in fixed type investments so that I can be playing with these numbers, much lower risk, high probability of it being positive, high probability of it being somewhere around 10% when I look at long periods of time. One thing that I want to note here, this is slightly off subject, but it's about risk though still. And I read this in my Ken Fisher book called Debunkery. I love it. Debunkery, get it, okay? Debunks rules of thumbs and myths about the stock market. One of them is, he talks about bonds are actually riskier than stocks in the long term because of inflation. If a bond returns, 3 or 4% and inflation is 3%, you're netting, 0 to 1%, maybe 2% on your bonds. And as you look at funding your retirement, bonds are actually riskier because the upside opportunity is so low, where if you're investing in something like the S&P 500 over 10-year periods, your probability of losing money is pretty low. Your probability of being around 10% is pretty high, and you could be as high as 19%. So risk to me is all about time. How long are you going to maintain that asset dramatically changes my thinking and the statistics around risk. Make sense? Let me know in the comments. It's Joe out.